Okay, welcome back. As gold and copper prices came off their all-time highs, which they hit earlier this year, markets continue to react to tariffs and geopolitics. My colleague Manisha Gupta caught up with Francisco Blanch, head of global commodity and derivatives research at BofA Securities, began by asking about the recent correction in precious metals. Listen in.
Look, we've been calling for $3,500 gold for the first half of this year. We got there, and we feel the market's going through a correction right now that could last a few months. Now we're still bullish longer term. We think longer term, maybe into the second half or into 2026, we'll breach $4,000 per ounce. But we're going through a correction because some of the extreme uncertainty that we've witnessed in recent months seems to be fading. Of course, it could come back. As we know, the Russia-Ukraine war, which was potentially heading into a ceasefire, into some form of peace deal, seems to be getting farther away from that. Also, we've heard about potential additional tensions between Iran and Israel. And then there is the negotiations around the U.S. budget in Congress. So I think we've hit a couple. We've gone very close to 2,500 a couple times, but to breach that level and keep moving up, we need some of this geopolitical turmoil, some of this policy uncertainty to creep back up again. Again, we expect it to happen into year end and into 26. But for now, we think it's unlikely we will move up in a straight line from here.
Francisco, I know you do not look at cryptocurrencies or Bitcoin for that matter, but we've seen an all-time high in Bitcoin as well for the week. In relative to other asset classes, and because it's the same money moving everywhere, how do you see this money deployed into cryptocurrencies?
Well, I mean, again, this new Trump administration has been very friendly to crypto, so I think that's likely enticed investors to go into crypto assets. We've also seen, of course, a rotation away, as I mentioned, from U.S. Fixed income securities with the U.S. Downgrade, U.S. debt downgrade last Friday. And I think also, said frankly, even the equity markets are no longer as attractive as they once were because of the uncertainty around tariffs and the pressure from the White House for companies to effectively eat the margin squeeze and not pass as much of the import cost into consumers. So all of that has created if you like, a bit of a cocktail for investors to look for alternative assets. And I think that's where crypto has been shining, coupled with, like I said, the more lax approach on the regulatory front to crypto.
I want to talk about silver as well now, and a fifth straight year of deficit, but the prices haven't really moved with the fundamentals. The industrial demand also seems to have taken a bit of a backseat, not the same record numbers that we saw in 2024. How do you see the silver demand availability going forward, and what's your price sense?
Well, in silver, we are looking at $40 per ounce. We think silver is one of the better investments because, of course, remember, silver is half precious, half industrial. And the precious aspect of silver has been driving it higher. The industrial side has been taking a back seat. But this will eventually change. Of course, tariffs mean weaker trade conditions. And we had a pretty strong trade window between the fourth quarter and the first quarter of last year and the first quarter of this year, where investors were buying in anticipation of tariffs. Now we have the tariffs, so we're going to go into a slower period, which will last for a quarter or two, and eventually we will see another pickup in industrial activity. And again, if you are to model silver, the main drivers are, of course, the price of gold, because silver is largely a precious metal, but also what's going on with industrial activity. And right now, industrial activity is going to be weaker, so that's one of the reasons silver has lagged on the move up the large upward lifting gold prices. It's really the weaker industrial backdrop we're seeing today. But we like silver. It's linked to solar panels. We still expect enormous investment in solar panels and in the electrification of everything. And we think silver plays a critical role. Remember, silver is the best conductor, the best electricity conductor in the world. So it's going to play a very important role. And we think going forward, once we go back into a more stable industrial activity environment, silver will shine again.
Since you are bullish on silver, Francisco, are you equally bullish in other base metals as well? Copper, for example, or aluminum for that matter, or a zinc, which has absolutely underperformed in 2025 till time?
Right. So those three industrial metals are a little different each. We like copper into next year. We think eventually we'll reach 10,500 and eventually $12,000 per ton. It's more of an 18-month view. The one thing in the short run, as I mentioned, is that we remain concerned about cyclical conditions, right? I kind of hinted at that in my comments on silver, but the cyclical demand drivers are weak, and they're weak because tariffs are sand on the wheels of the global economy. It's hard to believe that after all this tariff turmoil, we are not going to see lower growth. How weaker growth we're going to see is the question. Is it going to be, are we going to lose 0.3, 0.4, 0.5, 0.6 percentage points of global GDP? I don't know, but it'll be somewhere around that level. And this is also likely to impact industrial activity. So in the short run, we are a little cautious on industrial metals. Now, looking out, as I said, we are pretty bullish on copper because we think, again, copper is the second best conductor, and we are electrifying everything. So it's a big demand story. China's also putting a big stimulus program in place to counterbalance the tariffs, and there's true scarcity in ores, right? We've seen the refining charges going negative, meaning that basically miners are just getting the copper ores refined for free, pretty much, right? So it's an interesting market where there's scarcity at the base of the raw material, the copper ore, and therefore that's translated to firm pricing action. So we like copper. Aluminum, a bit of a different story. It's a metal that again is becoming more regionalized. The U.S. has imposed tariffs on aluminum imports, 25% tariffs. It's big numbers, right? I mean, President Trump wants to bring tariffs, wants to bring aluminum production to America. The problem aluminum has, Manisha, is that it takes a lot of power to make a ton of aluminum, exactly 14 megawatt hours. And that's one thing America cannot get enough of because of all the investments in artificial intelligence. We've heard from aluminum smelters in America that shut down a few years ago. They're like, well, will you reopen? They're saying, well, actually, we're thinking of selling our entire facility to an AI data center. Because it just takes a lot of power. The U.S. would need basically 7 new nuclear reactors to do that. And then for zinc, zinc is used mostly in galvanized steel. And as you know, the steel market has been lagging a little bit. Galvanized steel is basically to avoid corrosion. What's going on with zinc is a little, we have a softer steel market in China. It's linked to construction. Construction in China has been weakening up quite a bit, and there's a little more supply. So zinc hasn't underperformed the rally.
Very clearly. I'll come to energy markets now, and we've seen crude oil prices quite volatile as well. On one side, it was about drill, baby, drill. That's how we started this year. But if you look at the markets right now, the shale gas numbers, the oil and gas rig numbers are not so strong there. We've seen OPEC continue to increase production. The U.S. production is near record highs as well. It's a particular case of more supplies, even a surplus, and a weaker demand. How would you look at the crude oil prices within this?
I think you framed it really well, Manisha. We have a trade war which is pushing industrial demand down, and it's also pushing cyclical drivers down for oil. And on the other hand, we have a price war. OPEC is adding barrels at a time when the market doesn't need those barrels. And of course, next week, we're going to see another OPEC meeting. There's talk about potentially another outsized increase of 411,000 barrels a day. Remember, OPEC's already committed to adding 960,000 barrels a day in just about 3 months. That's a lot of oil. Now, granted, Some of it was already there, and some of it is just marking to market what producers like Kazakhstan and Iraq and others are already pumping above quota. So it's not a true increase of that size. But nonetheless, OPEC keeps adding as prices keep falling. Where is OPEC going with this? In my mind, there's three reasons why OPEC is adding barrels. Reason number one is market share. Reason number two is discipline, applying discipline to all their members. And reason number three is trying to push down U.S. inflation. Is if you like, OPEC contributing to bring down some of the inflation we've seen in America on the back of tariffs. And which one is the reason? I don't fully know, but there is, I think market share is clearly a very important reason. Saudi Arabia has the lowest market share, not just against the rest of the world, but also within OPEC that it's had in decades, and it's trying to bring its production back, right? Why is it doing it now? Why is it doing it fast? Maybe there's an element of discipline, and why now is maybe there is an element of trying to contribute to reduce U.S. inflation as, if you like, as a gesture to President Trump, which has been asking the group to increase output. So this means U.S. shale supply is going to flatten out. We expect a high oil plateau in the U.S. We expect production to really kind of stop growing. It's not going to fall at these price levels, but it's not going to grow either after 3 years of very fast growth. And at the end of the day, why is OPEC adding production? Remember, main reason is for the last 3 years, we averaged almost $90 a barrel, and U.S. shale production grew by 3.5 million barrels a day. OPEC is saying, enough, we're not going to keep oil this high. Instead, we're going to bring more volume. And rather than having 6 million barrels a day of exports at $90 a barrel, we're going to have 9 million barrels a day of exports at $60 a barrel.